This question tests your understanding of responsibility accounting and the different types of responsibility centers within an organization. Responsibility centers assign managers authority over specific aspects of organizational performance and evaluate them based on factors they can control. The four common responsibility centers are: Cost center. The manager is responsible for controlling costs and maintaining operational efficiency, but is not directly responsible for revenues or investment decisions. Revenue center. The manager is responsible only for generating sales or revenues. Profit center. The manager is responsible for both revenues and costs, and therefore for profit. Investment center. The manager is responsible for profits as well as investments in assets, and is evaluated using measures such as ROI or residual income. In this question, the production manager is responsible for manufacturing quality products, controlling production costs, and recommending equipment improvements or replacements. Although the manager may recommend capital expenditures, the primary responsibility remains efficient production and cost control, not generating revenues or earning profits. The emphasis on quality reflects operational performance, but does not change the type of responsibility center. A. Cost center. Correct. The production manager's primary responsibility is to control manufacturing costs while producing quality products efficiently. Recommendations regarding equipment do not make the manager responsible for investment decisions or asset returns. B. Investment center. Incorrect. Investment center managers control both profits and investment in assets. Merely recommending equipment purchases does not give the production manager authority over investment performance. C. Profit center. Incorrect. A profit center manager is responsible for both revenues and costs. The production manager does not control sales revenue. D. Revenue center. Incorrect. Revenue centers focus on sales generation rather than production efficiency and cost control. Correct answer. A. Cost center. The production manager is responsible primarily for controlling manufacturing costs while maintaining product quality, which is the defining characteristic of a cost center. Although the manager may recommend equipment improvements, responsibility for investment decisions and profitability typically rests with higher levels of management. This question tests your understanding of responsibility accounting, specifically the classification of responsibility centers within an organization. Responsibility centers are organizational units whose managers are evaluated based on the aspects of performance they can control. The four major types are: Cost center. The manager is responsible for controlling costs but not revenues or profits. Revenue center. The manager is responsible for generating revenues or sales, but has little or no responsibility for controlling production costs or invested assets. Profit center. The manager is responsible for both revenues and costs and is evaluated based on profitability. Investment center. The manager is responsible for profits and the efficient use of invested assets, often measured by ROI or residual income. In this question, Sarah Bellows manages a telecommunication sales team, and her departmental budget consists entirely of billings, revenues, from long-distance services, phone cards, and toll-free services. No cost or investment information is provided. Therefore, her performance is primarily evaluated based on the amount of revenue generated, making her department a revenue center. The key point is that responsibility center classification depends on what the manager is accountable for, not simply the department's name. A. Cost center. Incorrect. Cost centers focus on controlling expenses rather than generating revenues. B. Revenue center. Correct. Sarah's department is responsible for generating billings, sales revenue, from telecommunications services. Since her budget focuses on revenue generation rather than costs or investments, her department is a revenue center. C. Profit center. Incorrect. Profit centers are responsible for both revenues and costs. The information provided includes only revenues. D. Investment center. Incorrect. Investment centers are evaluated on profitability and asset utilization, neither of which is indicated in the question. Correct answer. B. Revenue center. Because Sarah Bellows manages a sales function whose performance is measured by billings, revenues, rather than costs or invested assets, her responsibility center is best classified as a revenue center. This question examines responsibility accounting, responsibility centers, and the importance of goal congruence within an organization. The production manager is evaluated as a cost center manager, meaning her performance is measured by how effectively she controls production costs relative to budget. In contrast, the sales department operates as a profit center, where performance depends on maximizing revenues and profits. The special order for 10,000 t-shirts presents an opportunity to increase company profits, but fulfilling it requires overtime labor, causing the production department to exceed its wage budget. If the production manager absorbs the overtime cost, she may appear to have performed poorly despite helping the company earn additional profit. Responsibility accounting aims to evaluate managers only for costs and revenues they can reasonably control while encouraging decisions that maximize overall organizational performance, not departmental performance. Therefore, the best solution is to assign the incremental overtime cost to the department that benefits from the special order, namely the sales department. This preserves fairness in performance evaluation while encouraging cooperation between departments and ensuring that profitable opportunities are not rejected because of internal budgeting conflicts. Accept the order and overrun the production manager's budget. Incorrect. This unfairly penalizes the production manager for supporting a profitable company decision. B. Refuse the overtime and produce only within budget. Incorrect. This may cause the company to lose a profitable sales opportunity because of rigid departmental budgeting. C. Accept the order and ignore the budget effect during performance review. Incorrect. While this avoids penalizing the production manager, it provides no formal accountability for the additional costs incurred. D. Charge the overtime to the sales department's budget. Correct. Since the overtime cost is incurred to secure the special sale, assigning it to the sales department, which benefits from the additional revenue, promotes goal congruence and fair responsibility accounting. Correct answer. D. Charge the overtime to the sales department's budget. This approach aligns departmental incentives with organizational objectives, ensuring that profitable opportunities are accepted while managers are evaluated fairly based on the activities they control.